Welcome to today's Explainer. We are putting on our financial detective hats, and our mission is simple. We're going to cut straight through the market noise to uncover the true, intrinsic value of Magnolia Oil and Gas. Acting as professional equity analysts, we're building a rigorous valuation from the ground up based strictly on the financial data. We want to see exactly what this business is actually worth. Let's dive right into it.
All right, take a really close look at this number right here, $30.09. According to our latest data, this is exactly where Magnolia Oil and Gas, ticker symbol MGY, last closed. We're going to use this specific price point as the baseline for our entire investigation today. So keep that $30 in the back of your mind as we start running these models.
Because, the crucial question we've got to ask ourselves is this: is MGY actually worth $30.09? Does the current market price accurately reflect reality? Or is there a massive hidden discount here just waiting to be discovered by those of us willing to dig into the financials?
Now, before we start crunching our valuation models, we need to know if this is a business that's even worth our time. And the data shows us it absolutely is. Magnolia is highly profitable, boasting a really impressive return on equity of 16.5%. Basically, what this tells us is that management is incredibly effective at taking shareholder capital and turning it into tangible hard profit. It proves we're dealing with a solid, cash-generating machine.
Here's our roadmap for the valuation today. First, absolute value, looking at cash and dividends. Second, relative value using peer multiples. Third, an asset-based valuation. And finally, a synthesis where we pull it all together for our final verdict.
So let's kick things off with Section 1, absolute value, focusing on cash and dividends.
In absolute valuation, we're looking at raw cash generation in total isolation. We honestly don't care what the rest of the stock market is doing right now. We only care about the cash this specific business can put into our pockets. To figure this out, we use a discounted cash flow, or DCF model. Step 1 is looking at free cash flow. Our metrics show MGY generated a massive trailing 12 months free cash flow of $409.16 million. Step 2 requires us to apply a discount rate to bring those future cash flows back to their present value today. And then Step 3 is just dividing that total company value by the share count to get our per share intrinsic value.
Now, as an analyst, you're often going to run into missing puzzle pieces. Our source report gives us the cash flow, but it doesn't explicitly state a weighted average cost of capital, or WACC. So to make the math work, we have to plug in some sensible default assumptions. Here we're assuming a standard 9% discount rate to account for market risk and a super conservative 2% terminal growth rate for the long-term future, alongside a multi-stage model for their dividend growth.
Check out the results of these models. The DCF model, driven by that strong $409 million in cash, gives us an implied intrinsic value of $42.78 per share. Meanwhile, the dividend discount model, which factors in MGY's current 2.19% yield, points to a fair value of $35.35. You notice something important here? Both of these absolute intrinsic values are significantly higher than our $30.09 baseline.
Moving right along to Section 2, relative value using peer multiples.
If absolute value is counting the actual bricks to build a house, relative valuation is basically just checking what the neighbors down the street sold their houses for. Now, our data doesn't list specific competitors, so we have to make a logical assumption here. We're evaluating Magnolia against major publicly traded peers like EOG Resources or Diamondback Energy. This tells us if Magnolia's price multiples are normal for an oil and gas company of its size right now.
Let's walk through these multiples. MGY's trailing price-to-earnings ratio sits at 17.49. At first glance, that might look like a moderate premium, but wait, look at the forward PE ratio. It drops all the way down to 11.44. That suggests the stock is actually priced much cheaper based on what it's expected to earn in the future. On top of that, an enterprise value to EBITDA ratio of 6.68 is generally right in line with the broader energy sector. So relative to its potential, it's priced very competitively.
Okay, on to Section 3, asset-based valuation and residual income.
For this framework, we literally stop looking at future cash flows entirely and just stare at the balance sheet. First up is net asset value, or NAV. Simply put, this is the absolute rock-bottom floor price of a stock. We calculate it by taking the fair market value of every single asset they own and subtracting all the liabilities and debt. Think of NAV as the ultimate worst-case scenario. If they closed their doors tomorrow and liquidated the whole business, what cash is left over? Our source data gives us a crucial clue here.
a price-to-book ratio of 2.90. By taking our $30.09 share price and dividing it by that 2.90 multiple, we can basically back into a net asset value per share of about $10.37. So that $10.37 represents the hard liquidation floor of the company. Good to know for sure, but remember, MGY is a highly profitable, ongoing business. They are not liquidating anytime soon.
Which brings us to Section 4, Synthesis, and our final verdict.
Synthesizing all of this paints a really clear picture. The asset-based NAV gives us a floor of $10.37, but honestly, that's low reliability for a thriving company. Our relative peer multiples put it in the $30 to $35 range, which is medium reliability, since it depends on the mood of the broader market. But our absolute models, high reliability. The dividend model at $35.35, and the DCF all the way up at $42.78. Why? Because Magnolia generates an incredibly strong 7.14% free cash flow yield. You just can't fake that kind of raw cash generation.
So here is our final judgment. The stock is currently trading at $30.09, but our calculated fair value range sits confidently between $35.35 and $42.78. The conclusion is pretty undeniable. Based purely on the math and the financial data, Magnolia Oil and Gas is trading at a significant undervaluation relative to its true intrinsic worth. But I want to leave you with one final provocative thought. The data explicitly states we have a 29.67% margin of safety on that free cash flow model. That is a huge buffer for any investor. So if our models show this much upside, what specific risk is Wall Street pricing in that we aren't seeing? What macro factors or industry fears are suppressing the stock right now? That, my friends, is the next great mystery for you to investigate. Keep questioning the numbers, and we'll see you next time.